Hi, good day everyone, good day colleagues, and good day Doc Marmelo. I am Kaiser and I will be reporting Introduction to Portfolio Management. Before we proceed, we need to define what is portfolio first, because portfolio can also be used not only in the aspect of investment, but it can also be used in the terms of project management. Like, combination of projects and combination of programs are considered to be portfolio. On the other hand, in the aspect of investment analysis, portfolio refers to a collection of investment tools such as stocks, shares, mutual funds, bonds, cash, and so on. So it depends on the investor's income, budget, and convenient time frame. So in the context of investment, portfolio refers to a collection of various assets owned by an individual or an institution. So katulad dito, it has stocks or shares or real estate, mutual funds, and cash equivalent. So if ang investor mayroon siyang stocks and then let's say meron din siyang mutual funds at the same time, considered as portfolio na siya. Or let's say meron siyang shares, meron siyang bonds, considered as portfolio na rin siya. So anything that is considered as portfolio as pagka may group na siya ng dalawang magkaibang asset. Now, the primary goal of portfolio is to achieve a balance between risk and return that aligns with the investor's financial goals and risk tolerance. So here, ang portfolio management is to diversify yung investment across different asset classes, wherein the investor aim to reduce the overall risk of their investment holdings. Because by holding a variety of assets, investors can mitigate the impact of poor performance in any single investment on the overall portfolio. It means na pag nag-diversify ang isang investor sa more than two assets or more than one asset, if nag-fail yung isang investment, pwede pa rin magkaroon ng returns doon sa isa because you diversified your investment. So the mix of assets in a portfolio can vary widely based on the investor's objectives, time horizon, and then yung risk appetite. Now, portfolio management is the art of selecting the right investment policy for the individuals in terms of minimum risk and maximum return. So ang goal ng portfolio management daw is to minimize yung risk and to maximize the return. So portfolio management involves strategically selecting and managing collection of investments, katulad ng mga stocks, bonds, mutual funds. So pipili siya doon, yung investor ay pipili, in order to achieve the best possible balance between risk and returns para ma-meet ang goal ng investor. Now, there are three components of portfolio management. We have investment objectives, risk tolerance, and then asset allocation. Let's start with investment objectives. Investment objectives are fundamental goals that guide the management of an investment portfolio. These objectives help define how the portfolio should be structured and what strategies should be employed to achieve desired outcome. Example ng investment objective is that an investor might be saving for retirement in the next 30 years, or the investor might save for child's education in 10 years. So the investment strategy would differ based on the time horizon and financial goals. So yung mga, as a person, let's say, you're an investor. Sa example kanina, mag-i-invest ka ba for the next 30 years para sa retirement mo once you reach your 60s? Or mag-i-invest mo ba yung money mo to save for your child's education in the next 10 years? Next key component ng portfolio management is yung risk tolerance na tinatawag. So refers to an investor's ability and willingness to endure, tanggapin, the market volatility and potential losses in their investments. It is a crucial factor in determining how a portfolio should be structured, as it helps balance the potential of returns against the likelihood of experiencing financial losses. Ang example dito sa risk tolerance is a young professional might have a high risk tolerance than those who are retired individual. So, kung mataas ang risk tolerance ng isang investor, let's say young professional, they usually invest in stocks for potentially higher returns. But we all know stocks are high risk. On the other hand, yung mga retired individual, they usually have lower risk tolerance. So they prefer to invest more on stable investments like bonds kasi yung mga bonds ay low risk. Bakit kaya ganon? Because young professionals, let's say nag-fail sila sa kanilang investment, they still have the ability to gain money in the future kasi bata pa sila, they can still work and have active income. Wherein the retired individual, since wala na silang trabaho after they retire, puro passive income na lang yung pumapasok sa kanila. So they tend to choose a more stable investment, although low returns, pero at least safe. Unlike sa mga young professionals, mataas ang kanilang risk tolerance, so they invest on high risk investment. But at the same time, umaasa sila na mataas rin yung return, like instant return, pero mataas din. And then the third component ng portfolio management is asset allocation. Asset allocation is a fundamental strategy in portfolio management. This involves distributing investment across various asset classes to balance risk and reward according to investors' goals, risk tolerance, and investment horizon. Asset allocation is designed to optimize the portfolio's performance by spreading investment across different types of assets, which can help manage and enhance potential returns. Ang example ng asset allocation na tinatawag is for an investor to have a balanced portfolio. The investor might allocate 60% of his money to equities like stocks, and then 40% sa fixed income securities like mga bonds. Ngayon, sa asset allocation, na-balance mo na yung portfolio mo because 60% of your investment are high risk. 40% are low risk. But this helps you achieve growth while managing risk. Paano? Let's say, yung 60% dahil high risk siya, nag-fail, you still have backup which is 40% yung bond na low risk when it comes to investment. So ito ang purpose ng asset allocation and it is one of the key components ng portfolio management. Now let's proceed with strategies sa portfolio management. We have active management, passive management, strategic allocation, and tactical allocation. Here, sa active management, this involves frequently buying and selling securities with the aim of outperforming a specific benchmark, such as a stock index. For active management, active managers conduct extensive research and analysis to identify undervalued stocks or market inefficiencies. Here sa active management, mayroong strategy sila, dalawa, stock picking and market timing. Sa stock picking, the managers will select individual stocks that are believed to have high growth potential. And then they also utilize the market timing strategy because active managers attempt to predict market movements and make trades accordingly. So pinagbabasihan nila yung movement sa market. So while this strategy, the active management, can lead to higher returns, it often comes with increased transaction costs and higher risks. So successful active management should require skill, experience, and sometimes a bit of luck. Swertihan, ganun. Now let's proceed with the opposite, passive management. Passive management aims to replicate the performance of a market index rather than trying to outperform it. So sa active management, they want to outperform yung market index. But here, replicate lang, gagayahin lang sa passive management. So this strategy typically involves investing in index funds or exchange-traded funds or ETFs that track specific indices like S&P 500. Ang key feature ng passive management ay first is lower costs because there are fewer trades na nagaganap sa passive management. This means lower fees and lower expenses. Also, in the passive management, nagre-reduce ng risk pag ito yung i-utilize because by diversifying across a broad index, investors can mitigate the risks associated with individual stocks. So this type of management sa portfolio, which is passive management, it is based on the belief that markets are efficient and that is consistently outperforming them is challenging. So parang pinagpapalagyan na lang ng mga investors dito na yung market is already efficient na there's no need for you to outperform it rather than unlike sa active management, dito sa passive management, sabay na lang sa flow, gagayahin na lang yung market trends, specifically yung pinapakita ng ng S&P 500. Now we have a strategic allocation. It is a long-term investment strategy that involves setting a fixed asset allocation based on an investor's goals, risk tolerance, and time horizon. So for a strategic allocation, it typically includes number one, diversification. We already know what is diversification, right? So diversification is spreading investments across various assets like, stocks, bonds, real estate in order to reduce risk. Strategic allocation also has what we call rebalancing. Sa rebalancing naman, it is, periodically adjusting the portfolio to maintain the desired allocation as market conditions change. So, as a summary, strategic allocation is a fundamental strategy for many investors because strategic allocation focuses on stability and growth over time. We also have the fourth component is tactical allocation. Tactical allocation is more flexible approach that allows for short-term adjustments in response to changing market conditions or economic indicators. It combines elements of both active and strategic management. So sa tactical allocation, it involves market analysis. So sa market analysis, investors utilize research to identify trends or shifts in market, like market shift, that may influence the performance of assets. Tactical allocation also requires flexibility. So here, investors make temporary adjustments to take advantage of perceived opportunities or to protect against potential downturns. While tactical allocation can enhance returns, it also involves risk and requires continuous monitoring of the market. And we have examples of portfolio management. One, conservative portfolio, moderate portfolio, that's the number two, and then aggressive portfolio. For conservative portfolio, or the safe portfolio, it preserves capital with minimal risk. Example is a retired individual who needs stable income might choose a portfolio consisting of 70% bonds and 30% cash equivalents. This portfolio aims to provide steady income while minimizing the risk of loss. So again, nabanggit na naman sa example is retired individual. Itong mga retired individual kasi, again, they no longer have, most of them, they no longer have active income. So if magi-invest pa sila sa mga risky na investment and then nag-fail, wala na silang panghahawakan pa. So unless otherwise, magtatrabaho uli sila. So they usually invest, let's say, 70% bonds and 30% cash equivalents. Let's say itong invest mo na 30% nag-fail, at least meron pa silang 70% bonds. Kaya nga lang yung return dito is minimal lang. Minimal risk, minimal return. High risk, high return. Usually ganun yun. Now we have moderate portfolio. So moderate portfolio balances between risk and return. An example dito is a middle-aged investor. Let's say ang edad nila is 40, 50, ganyan. With a medium-term horizon, might opt for a mix of 50% stocks, 40% bonds, and 10% real estate. This allocation seeks to provide growth through stocks, stability through bonds, and diversification through real estate. So bakit tinawag na moderate portfolio? Kasi 50% ay na-invest sa high risk, which is stocks. While the other 50% na-invest sa bonds and real estate. Kasi ang bonds and real estate are both low risk investment. Now we have aggressive portfolio. It maximizes returns with higher risk. So from the term itself, aggressive. So a young investor can be 20-year-old investor or a 30-year-old investor with a long-term horizon might invest 80% in high risk, high return assets like emerging market stocks or speculative investments. This approach aims for significant growth, accepting higher volatility and risk. So here, kaya aggressive siya, it's more than 50% na invest sa high risk na investment. Let's say stocks, ganyan. Itong emerging market stocks. And then 20% ay na-invest lang sa mga low risk na assets. So it's considered aggressive. So conclusion, portfolio management is about making informed decisions to tailor an investment strategy that aligns with an individual's goals, risk tolerance, and time horizon. So for portfolio management, by carefully selecting and managing investments, investors aim to achieve optimal returns while managing risk. Of course, investors are also considering changes in market and investors' personal circumstances. So that's all, and thank you for listening.